Hello everybody, so welcome again to my channel. Today we're going to be continuing the lesson about basic principles of accounting, which is matching principle. So I will begin, I'm gonna be recording the audiobook for this intermediate accounting. The third basic principles of accounting, matching principle. In recognizing expenses, the approach is let the expense follow the revenues. Companies recognize expenses not when they pay wages or make a product, but when the work or service or the product actually contributes to revenue. Thus, companies tie expense recognition to revenue recognition. This practice is referred to as the matching principle because it dictates that efforts or expenses be matched with accomplishment or revenues whenever it is reasonable and practicable to do so. Some costs, however, are difficult to associate with revenue. As a result, some other approach must be developed. Often companies use a rational and systematic allocation policy that will approximate the matching principle. This type of expense recognition involves assumptions about the benefits that a company receives as well as the costs associated with those benefits. For example, a company like Intel or Motorola allocates the cost of a long-lived asset over all of the accounting periods during which it uses the asset because the asset contributes to the generation of revenue throughout its useful life. So let's take a look at the example for the Hollywood accounting. Hollywood accounting illustrates that the problem of expenses recognition is as complex as that of revenue recognition. Following then existing GAAP standards, major motion picture studios capitalize advertising and marketing costs and then amortize these costs against revenues over the life of the film. As a result, many investors suggested that the studios overstated their profit numbers. Under a new GAAP standard, the studios must now amortize these costs over no more than 3 months. In many cases, the studios have to expense them immediately. Similarly, the studios often allocated the costs related to abandoned projects to overhead, those spreading them out over the lives of the successful projects. Not anymore. The studios must now expense these costs as incurred. The more conservative approach results from a stricter application of the definitions of assets and expenses. While many argue that advertising and marketing costs have future surface potential, difficulty in reliably measuring these benefits suggests they are not assets. Therefore, a very short amortization period or immediate write-off is justified. Under these new guidelines, investors will have more reliable measures for assessing the performance of companies in this industry. Companies charge some costs to the current period as expenses or losses simply because they cannot determine a connection with revenue. Examples of these types of costs are officers' salaries and other administrative expenses. Costs are generally classified into two groups, product costs and period costs. Product costs, such as material, labor, and overhead attached to the product. Companies carry these costs into future periods if they recognize the revenue from the product in subsequent periods. Period costs such as officers' salaries and other administrative expenses attached to the period. Companies charge off such costs in the immediate period, even though benefits associated with these costs may occur in the future. Why? Because companies cannot determine a direct relationship between period costs and revenue. As indicated in the discussion of Hollywood accounting, there is some debate about the conceptual validity of the matching principle. A major concern is that matching permits companies to defer certain costs and treat them as assets on the balance sheet. In fact, these costs may not have future benefits. If abused, this principle permits the balance sheet to become a dumping ground for unmatched costs. In addition, there appears to be no objective definition of systematic and rational. The fourth basic principles of accounting is full disclosure principle. In deciding what information to report, companies follow the general practice of providing information that is of sufficient importance to influence the judgments and decisions of an informed user. Often referred to as the full disclosure principle, it recognizes that the nature and amount of information included in financial reports reflects a series of judgmental trade offs. These trade offs strive for sufficient detail to disclose matters that make a difference to users, yet sufficient condensation to make the information understandable, keeping in mind cost of preparing and using it. Users find information about financial position, income, cash flows, and investments in one of three places: within the main body of financial statements, in the notes to those statements, or as supplementary information. As discussed in Chapter 1, the financial statements are the balance sheet, income statement, statement of cash flows, and statement of owner's equity. They are a structured means of communicating financial information. To be recognized in the main body of financial statements, an item should meet the definition of a basic element, be measurable with sufficient certainty, and be relevant and reliable. Disclosure is not a substitute for proper accounting. As a former chief accountant of the SEC noted, good disclosure does not cure bad accounting anymore than an adjective or adverb can be used without or in place of a noun or verb. Those, for example, case basis accounting for cost of goods sold is misleading. Even if a company discloses accrual basis amounts in the notes to the financial statements. The notes to financial statements generally amplify or explain the items presented in the main body of the statements. If the main body of the financial statements gives an incomplete picture of the performance and position of the company, the notes should provide the additional information needed. Information in the notes does not have to be quantifiable, nor does it need to qualify as an element. Notes can be partially or totally narrative. Examples of notes include descriptions of the accounting policies and methods used in measuring the elements reported in the statements, explanations of uncertainties and contingencies and statistics, and details too voluminous for inclusion in the statements. The notes can be essential to understanding the company's performance and position. Supplementary information may include details or amounts that present a different perspective from that adopted in the financial statements. It may quantifiable information that is high in relevance but low in reliability. For example, oil and gas companies typically provide information on proven reserves as well as the related discounted cash flows. Supplementary information may also include management's explanation of the financial information and its discussion of the significance of that information. For example, many business combinations have produced financing arrangements that demand new accounting and reporting practices and principles. In each of these situations, the same problem must be faced, making sure the company presents enough information to ensure that the reasonably prudent investor will not be misled. We discussed the content arrangement and display of financial statements along with other facets of full disclosure later in chapters 4, 5, and 24. So, see you all again very soon. This is the end of this video. Thank you very much for listening and watching this video. Hope all of you can learn something from this video and see you all again very soon. Have a great day. Bye.